The Jekyll Island Meeting, what really happened, and why it still matters. In November 1910, 7 powerful men boarded a private rail car in Hoboken, New Jersey, heading to Jekyll Island, Georgia. This meeting has been called everything from the birth of American banking stability to the greatest financial conspiracy in history. After 2 decades of studying financial history, I can tell you the truth is far more nuanced and far more interesting than either extreme suggests. Let me take you through what actually happened, why it happened, and what it means for your money today. Because understanding Jekyll Island isn't about conspiracy theories or blind faith in institutions. It's about understanding how modern banking actually works and why we ended up with the system we have. The crisis that changed everything. October 1907. The New York Stock Exchange lost nearly 50% of its value from the previous year. Panic spread like wildfire. Depositors rushed to withdraw their savings. Banks couldn't meet the demand. Without enough cash reserves, banks failed across the country, taking people's life savings with them. Here's what most people don't understand about 1907. This wasn't just a stock market crash. This was a complete breakdown of the payment system. Businesses couldn't get credit to meet payroll. Farmers couldn't get loans for seed. The entire economic engine seized up. And here's the crucial part. There was no lender of last resort. No institution with the authority and resources to inject liquidity into the system. America had operated without a central bank since Andrew Jackson killed the Second Bank of the United States in 1836, 71 years earlier. Jackson had called the Second Bank the monster and warned that it concentrated too much power. He was right to be concerned about concentrated power, but the consequence of having no central bank became brutally clear in 1907. Enter J.P. Morgan. At 70 years old, Morgan was the most powerful banker in America. When the panic hit, he didn't wait for the government. He locked the major bankers in his library on Madison Avenue and forced them to pool resources. Morgan personally organized the rescue, using his own capital and reputation to stop the bank runs. It worked. Morgan saved the system. But here's what's crucial to understand. Morgan saved the system through the sheer force of one man's personal wealth and reputation. Think about that. The entire American economy depended on whether one private citizen decided to step in. This terrified everyone, not just the bankers, but business leaders, farmers, workers, everyone who depended on a functioning financial system. The question became unavoidable. What happens next time when there might not be a J.P. Morgan? The political response. In 1908, Congress passed the Aldrich-Vreeland Act, creating the National Monetary Commission to study banking reform. Senator Nelson Aldrich, a Republican from Rhode Island, was appointed chairman. Now, this is where the conspiracy theories start to have a kernel of truth. Aldrich was indeed extremely wealthy. He was indeed J.P. Morgan's business partner. His daughter had married John D. Rockefeller Jr. These weren't wild accusations. These were facts. But here's what the conspiracy version leaves out. Aldrich was appointed because he chaired the Senate Finance Committee. He was the expert on monetary policy in Congress. And critically, he was tasked with studying European central banking systems to find a solution. Aldrich spent 2 years traveling through Europe, studying the Bank of England, the Reichsbank, the Banque de France. He learned how these institutions stabilized their banking systems, how they acted as lenders of last resort, how they managed currency supply. What he discovered was that every major economy had a central bank except the United States, and every major economy had more banking stability than the United States. The secret meeting. November 22, 1910. 7 men departed separately for Jekyll Island to avoid being seen together. They were told to use only first names. The secrecy was real. Who were these men? Senator Nelson Aldrich, Frank Vanderlip, president of National City Bank, Paul Warburg from Kuhn, Loeb and Company, Henry Davison, senior partner at J.P. Morgan and Company, Charles Norton, president of First National Bank of New York, Benjamin Strong, representing J.P. Morgan, Arthur Shelton, Aldrich's secretary. These 7 men represented enormous wealth. That's not disputed. What's disputed is why they met in secret and what they actually created. The conspiracy version says they met in secret because they were stealing the monetary system. But let me offer you another explanation, one supported by the historical record. They met in secret because any banking legislation written by bankers would be dead on arrival politically. The American public in 1910 deeply distrusted Wall Street. The populist movement had spent decades railing against the money trust. William Jennings Bryan had run for president 3 times on a platform of opposing the gold standard and Eastern bankers. If the press reported that Wall Street bankers were writing banking legislation, public opposition would kill it immediately, regardless of its merit. So they disguised it as a duck hunting trip. What they actually created. Over 10 days, these 7 men drafted the framework for what would become the Federal Reserve System. But here's what's crucial. What they created at Jekyll Island was not the Federal Reserve Act that Congress passed 3 years later. The Jekyll Island Plan called for a central bank dominated by bankers with minimal government oversight. It was called the Aldrich Plan when presented to Congress in 1911. And it failed, spectacularly. Democrats controlled Congress after the 1912 elections. They rejected the Aldrich Plan as a banker's scheme. President Woodrow Wilson supported banking reform, but demanded major changes. What emerged as the Federal Reserve Act in 1913 was significantly different from the Jekyll Island Plan. Yes, it retained the regional reserve bank structure. Yes, it gave member banks a role in selecting directors, but it added crucial government oversight that wasn't in the original plan. The Federal Reserve Board in Washington would be appointed by the President and confirmed by the Senate. The board would set policy. The regional banks would implement it, but ultimate authority rested with politically accountable officials. This wasn't the banker's dream. This was a compromise between banker expertise and democratic accountability. The structure that emerged. The Federal Reserve System that launched in 1914 had 3 key features. First, 12 regional Federal Reserve banks, privately owned by member banks in each district. These regional banks would provide liquidity, clear checks, and serve as lenders of last resort in their regions. Second, a Federal Reserve Board in Washington, appointed by the President, setting overall policy. Third, member banks would receive a 6% dividend on their stock in the regional Fed banks, but profits above that would go to the U.S. Treasury. Was this perfect? No. Was it designed solely to benefit bankers? The historical record says no. The real innovation. Here's what the Federal Reserve actually accomplished and why it mattered. Before the Fed, bank panics were regular occurrences. The U.S. experienced major banking panics in 1873, 1884, 1890, 1893, and 1907. After the Fed was established, the frequency of banking panics dropped dramatically. Why? Because the Fed could serve as a lender of last resort. When a bank faced a temporary liquidity crisis, it could borrow from the Fed using good collateral. This stopped bank runs before they started. The Fed also created an elastic currency. Before the Fed, the money supply was rigid, based primarily on gold reserves. During harvest season, when farmers needed credit, money would become scarce and interest rates would spike. The Fed could expand and contract the currency based on legitimate economic needs. Did this benefit banks? Yes, but it also benefited farmers, businesses, and workers who depended on a stable financial system. The uncomfortable truths. Now, let me address the criticisms that have merit. The Federal Reserve structure does create potential conflicts of interest. Regional Fed banks are indeed owned by member banks. Those member banks do elect some of the directors of regional Fed banks. This creates a revolving door between Wall Street and the Fed. The Fed has made catastrophic mistakes. During the Great Depression, the Fed contracted the money supply when it should have expanded it, turning a recession into a catastrophe. Milton Friedman, a fierce critic of government intervention, said the Fed's errors caused the Depression. The Fed has repeatedly bailed out large banks while letting smaller banks fail. In 2008, the Fed created emergency lending facilities that primarily benefited the largest financial institutions. This creates moral hazard, encouraging excessive risk-taking. The Fed's independence from congressional oversight does limit democratic accountability. The Fed can conduct monetary policy without direct political interference, which prevents short-term political manipulation, but also shields it from public scrutiny. These criticisms are valid. They're not conspiracy theories. They're legitimate concerns about institutional design and accountability. The inflation question. Let's address the claim that the Fed has destroyed the dollar's value. Since 1913, the dollar has lost roughly 98% of its purchasing power. This is mathematically true. But here's what that statistic doesn't tell you. In 1913, Average annual income was about $800. Today, median household income is about $75,000. Adjusted for inflation, real purchasing power has increased dramatically. In 1913, average life expectancy was 52 years. Today, it's 79 years. Infant mortality has dropped 93%. These improvements required massive economic growth and productivity gains.
The question isn't whether prices are higher today than in 1913. Of course they are. The question is whether we're better off economically by virtually every measure: living standards, health outcomes, economic opportunity. The answer is yes. Moderate, predictable inflation has actually enabled this growth. It encourages investment over hoarding. It allows real wages to adjust without nominal wage cuts, which are psychologically and politically difficult. It reduces the real burden of debt over time. Compare this to the deflation America experienced in the late 1800s under the gold standard. Prices fell, which sounds good until you realize that deflation punishes debtors, rewards hoarders, and discourages investment. Farmers borrowed money to buy equipment, then had to repay those debts with dollars that were worth more than the dollars they borrowed. This crushed the agricultural economy. The 2008 crisis and accountability. The financial crisis of 2008 revealed both the Fed's essential role and its fundamental flaws. When Lehman Brothers collapsed in September 2008, credit markets froze completely. Banks stopped lending to each other overnight because they didn't know which institutions were solvent. The commercial paper market, which funds day-to-day business operations, shut down. The entire global financial system came within hours of complete collapse. The Fed's response was massive and unprecedented. It cut interest rates to near zero. It created emergency lending facilities. It bought trillions in government bonds and mortgage-backed securities. And yes, it provided $29 trillion in emergency loans to financial institutions, revealed only after Bloomberg News sued for disclosure. Did this save the financial system? Yes. Did it primarily benefit the large banks that created the crisis? Also yes. This is the fundamental tension. The Fed faced an impossible choice: let the system collapse, causing a depression that would devastate millions of innocent people, or bail out the institutions that caused the crisis, creating moral hazard for future crises. They chose the bailout. And it worked in the narrow sense that it prevented economic collapse. But it also confirmed the worst suspicions about the Fed: that it exists to protect big banks at taxpayer expense. The path forward. So what should we make of Jekyll Island 114 years later? The Federal Reserve is neither a pure conspiracy to rob the American people, nor a perfectly designed institution serving the public interest. It's a compromised structure that reflects both banker influence and democratic accountability, both technocratic expertise and political pressure. The real question isn't whether the Fed is good or evil. The real question is how to reform it to serve the public interest better, while maintaining the technical expertise needed to manage monetary policy. Here are reforms worth considering. First, increase transparency. The Fed has improved disclosure significantly since 2008, but emergency lending facilities should be disclosed in real time, not years later. Sunlight is the best disinfectant. Second, address conflicts of interest. Regional Fed bank directors should not be allowed to vote on policies that directly benefit their own institutions. This seems obvious, but isn't current practice. Third, broaden the Fed's mandate accountability. The Fed currently focuses primarily on inflation and employment, but its policies have massive distributional effects. It should be required to analyze and report on how its policies affect wealth inequality. Fourth, strengthen congressional oversight without politicizing monetary policy. This is a delicate balance, but it's achievable. The Bank of England manages it. The European Central Bank manages it. The Fed should face rigorous questioning about its decisions while maintaining operational independence. Fifth, end too big to fail. The largest banks should face stricter capital requirements, making bailouts unnecessary. If an institution is too big to fail, it's too big to exist in its current form. The bottom line. The 7 men who met at Jekyll Island in November 1910 were not saints trying to save the American economy from altruistic motives. But they also weren't cartoon villains plotting to steal America's wealth. They were bankers who understood that the banking system was broken and needed reform. They also understood that any reform would need to serve their interests to gain their support. They created a plan that did both.
That plan was then modified by democratic politics, strengthened with government oversight, and implemented as the Federal Reserve System. That system has evolved over 114 years, sometimes serving the public interest, sometimes serving banker interests, usually some combination of both. Your money today is managed by this system. Understanding it means understanding both its genuine accomplishments and its serious flaws. It means rejecting both blind conspiracy theories and uncritical faith in institutions. The creature from Jekyll Island is real, but it's not a monster. It's a deeply flawed institution created by imperfect people trying to solve a real problem. And, like any human institution, it needs constant scrutiny, criticism, and reform to serve the public interest. That's the real lesson of Jekyll Island. Not that 7 men stole your money, but that institutional design matters, that power requires accountability, and that the fight for a financial system that serves everyone rather than just the wealthy is ongoing. The question isn't what happened in November 1910. The question is what we do now, in 2025, to make the system work better for everyone. That fight continues, and it's one worth having, with facts, not myths.